I suppose it's fair to say, in my sister's account, I have no career risk. She isn't going to fire me.
Ever since legendary investor Jeremy Grantham told WealthTrack how he kept his sister's money safe during the financial crisis, I have wondered, what about all the other women, many of them divorced, widowed, or lifelong singles who don't have Jeremy Grantham to call upon? Well, we've started a new feature on WealthTrack's website called WealthTrack Women. On a regular basis, investment pros who specialize in advising female clients will answer questions vital to the financial health of women. Look for it on WealthTrack.com. This week on WealthTrack, a world-traveling great investor who treks to unusual, out-of-favor places to find value in shunned bonds and currencies. Why has Templeton Global Bond Fund's Michael Hassenstab visited China, South Korea, and even Ukraine recently? His contrarian views are next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. How does a global bond fund deliver equity-like returns over the long term and stay ahead of its peers and bond markets in a low interest rate environment? By avoiding those low interest rate countries and investing in currencies and debt of faster growing emerging markets. And that partially describes the strategy of next generation great investor Michael Hassenstab at the Templeton Global Bond Fund, which he has managed for more than a decade. Hassenstab, Morningstar's Fixed Income Fund Manager of the Year in 2010 and winner of numerous other awards, oversees close to $200 billion worth of fixed income assets. Known for making sizable and prolonged contrarian investments, Hassenstab is acting true to form today. At a time when many investors are fleeing emerging markets, he is investing in them. When much of the world is concerned about deflation, he is worried about inflation. While the Federal Reserve is completing its quantitative easing policy by gradually ending its bond buying program, Hassenstab is convinced another central bank, the Bank of Japan, will more than fill the void and flood the world with inflationary liquidity. And while much of the investment community is worried about how much China is slowing, he is encouraged by how much it is growing. While other investors were buying U.S. Treasuries for their safety and liquidity several years ago, Hassenstab was an early seller, a bearish position he maintains to this day. I asked him why.
Well, it's a combination of factors. On the one hand, we just don't see value in the U.S. Treasury market. We have, from an economic standpoint, reasonably good growth coming in at around 3%, inflation coming in around 2%. That is very inconsistent with a 10-year Treasury yield that is below 3%. So if you look throughout history, those type of growth and inflation dynamics would imply a 10-year Treasury yield that's closer to 4 to 5%. So from a valuation standpoint, it doesn't make sense. And the reason it's distorted is that the largest buyer of Treasuries is our own government. So because there's an artificial buyer in place, we just don't know what the clearing rate is. So from our standpoint, we don't see value there, and we just need to see the Fed back away and see where a real price settles out. But our inclination is that that real price will be at a yield much higher than it is today.
So the Fed is starting to back out, and if all goes according to plan, the quantitative easing plan of a bond buying by the Federal Reserve is going to end at the end of this year. Does that affect your view of the U.S. Treasury market at all?
Well, it depends what the yield is.
Okay.
So we would just need to see what the valuation is. But from our standpoint, we have the whole world to choose from, and
yes.
So there's easier opportunities to earn much higher yields without taking a lot of interest rate in other countries, in Korea and Mexico and Poland, where you can earn a higher yield than you get in a 10-year U.S. Treasury yield, but you're only buying a 3-month Treasury bill. So you're not taking interest rate risk, but you're getting a higher yield in countries that we think have good underlying value. And to your original question about home country bias, It's, I think, unfortunate that most investors in the US have so much exposure to just one market, and their bond portfolio is highly concentrated in US core assets. And that has been okay for the last 30 years when you've had a secular decline in rates. But going forward, that environment is probably going to be very different. And our advice to investors is, can you move away from that home country bias and better diversify your bond portfolio?
So let's talk about how you are diversifying your bond portfolio. And I'm also interested in the fact that you've kept your durations or in maturities and your interest rate risk, which there's more interest rate risk in a bond or fixed income security the farther out you go in maturity. So you've kept your maturities quite low in your portfolio. Why?
Generally, we think we're at the turning point in interest rates. As I mentioned, for 30 years, rates have been coming down.
Right.
And we think that is over. And so we want to position for an environment where rates go higher, and to preserve capital in a higher interest rate environment, you need to have very short duration assets so that you're not subject to the price effects when rates go higher, the negative price effects. So yeah, our portfolio by and large has very, very short duration, negative correlation to rates, and that's our way of positioning for what we think will be a very different interest rate environment going forward.
Have you been surprised at how relatively benign, at least in the developed world, that interest rates have been?
Yes, we thought it would probably go higher earlier,
right.
But at the end of the day, would rather be early than wrong. And so we positioned very defensively on interest rates for a number of years, and that didn't work for some time. And then when it worked, it was very dramatic. We think about last year when rates moved up, over 100 basis points in a very short period of time.
And you're talking about U.S. Treasuries.
U.S. Treasuries.
Right.
And so we were glad that we were defensively positioned prior to that event, so that when rates went higher in most bond funds, U.S. Treasury market lost about 5% value, we were able to still generate a positive return in that environment. So for us, it's all about how do we get a positive return in an environment where most bond funds generate negative returns when rates go higher. So yes, we were early, but as I said, I'd rather be early than wrong.
And what about your inflation outlook? And again, if you look at the way a number of other global bond managers are talking, and central bankers, for instance, are talking, they're worried about deflation or at least disinflation, and yet you're still focused on inflation. Why?
We have printed so much money globally. It's not just the Fed, but it's the ECB, it's the Swiss National Bank, and it's now the Bank of Japan, have flooded the world with liquidity. And it's only a matter of time before that feeds into inflationary pressures. So we don't know the exact timing, but we do know at some point we will have an inflationary environment that's very different than what we have today. The other factor about this debate between inflation and deflation, think about it here in the US. We had a period with double-digit unemployment, with a recession, with huge deleveraging and financial collapse, and we never really had deflation. So now we have an environment where the banking system is a lot better. It's functioning not completely, but it's better. We have positive growth. We have unemployment that is half of what it was before. So it'd be very unlikely to have deflation in that environment if we never had it when things were much worse. So I think the fear of deflation, certainly in the US, is overstated. Europe, you could make a bit more of an argument, but then if you go beyond some of the G3 countries and look at emerging markets, you're already seeing actually inflationary pressures build. Places like Brazil, places like India, inflation is actually a real threat in some other parts of the world. So inflation will be different in different countries. Emerging markets are likely to face inflationary pressures well before the developed world. And then we have to look at inflation of not just goods, but asset prices. Clearly, this Fed QE program has created asset price inflation.
Right.
So we've already seen inflation. It's just been in different areas.
You just mentioned the fact that Japan is pumping very vigorously and that expanding their monetary base. And so tell me why you're keeping your eye on Japan and what the implications are for the global bond markets.
Japan, I think, has huge implications globally. We're all focusing on Fed tapering, that they're going to be printing less money, but at the same time, Japan is ramping up their QE program and is likely to continue this beyond the end of this year. And the reason that we expect them to continue is twofold. One, the only part of Abenomics that is really functioning at this point is the first arrow, which is the printing of money. And so because the second and third arrow, which are fiscal consolidation and structural reform to get growth, have yet to really kick in, he has to rely upon that one lever that is working, and so place an even larger emphasis on the QE program.
So this is President Abe of Japan?
President Abe,
right.
Correct. The other reason we expect printing of money to continue in Japan is that it's a big part of really monetization of their large debt. They have over 200% debt to GDP. They're running fiscal deficits on the magnitude of 8 to 9%. They have a shrinking current account surplus. So they used to have this huge pool of domestic savings that they could recirculate to fund their government debt market.
Right.
The reality is, with changing demographics and a trade surplus that's gone from surplus to deficit, they no longer have that pool of savings. So the only entity large enough to fund their government debt is the government itself. And because we don't see this debt dynamics changing, we think the need to do money printing to finance the deficit will go on for years to come. So Japan is, we think, just embarking on a massive QE program. This is important particularly for global liquidity environment, because if this continues, it will more than offset what the Fed is pulling back. And so if you're a small Southeast Asian country, the flows from Japan are going to be quite significant. So we don't think there's going to be a shortage of global liquidity provided that QE continues in Japan. In fact, the challenge for many countries is going to be too much money coming into these markets from Japan.
Talk to us about the role of the dollar. And again, I'm thinking if Japan is kind of becoming the central bank to the world and replacing as the U.S. Fed withdraws, what are the currency repercussions of that vis-a-vis the U.S. dollar?
Certainly, I think because the Fed will be exiting a QE program at the same time Japan is ramping it up, at the same time the ECB is probably needing to ramp up some sort of easing, you would likely see a much stronger dollar against the yen, a much stronger dollar against the euro over the next 1 to 2 years.
So how are you taking advantage of that?
Quite simply, long dollar, short yen, long dollar, short euro. So on the one hand, we have a long dollar bias.
Right, from a currency point of view.
From a currency standpoint.
Right.
But there are also some currencies that we actually think will weaken against the dollar. In places like Mexico, places like Korea, that a stronger U.S. economy is actually very good for those countries because they're highly exposed to the export markets. So as the U.S. economy improves, Mexico sells more cars, Korea sells more TVs, and so a stronger U.S. economy will actually benefit a handful of emerging markets that are cyclically tied to the U.S.
Another contrarian call that you've made is that you are actually more positive on China than many of your competitors. What is there to be positive on China about?
So I've spent probably more time in China this year than many other countries because it is so critical to the global outlook. And really we were asking two questions. Can China grow at 7%, or are they going to face a hard landing? And are we on the verge of a Lehman-style banking crisis? And those were the two questions that were central on our research trips. And we came away from them affirmed that China can grow at 7%, and we don't think there's a banking system crisis, which gives us an optimistic outlook on China. Now, the reason we come away positive on the growth outlook is it's important to break apart the growth drivers into two components. One is investment and one is consumption. The negativity on China really surrounds excess capacity in certain housing-related sectors of investment.
So building booms that
is
are
coming
not
to a
sustainable.
close. Correct.
Right. So that is coming to a close.
That is absolutely coming to a close. You have an excess capacity of windows, of steel, of cement. Anything housing-related is in excess capacity.
And of course, they've all been financed by banks and by the Chinese government.
Yeah, there was a lot of bank finance going into that, and so it is related to the question of can they absorb some of those losses. So that is one part of the story in China that is somewhat negative. However, there are two other components that actually more than offset that. One is investment related to the urbanization process. China is in the process of moving hundreds of millions of people from the rural sector into the urban sector, which requires massive investment in subways, in sewage systems, water purification, schools, housing. That is a process that is a 100-year-long dynamic that we're only about halfway through.
You sound very Chinese when you say that.
Well, there's the long perspective.
View.
There's a long view, yeah. I mean, in the U.S., we went from an urban population of 10 to 20% in the 1850s to now the complete reverse, where the urban population is now 80%. That urbanization process typically takes about 100 years. So there is this long-term structural change in China, which is going to create a huge need for investment. This investment, we think, will be healthy investment, productivity enhancing investment. So there is a part of the investment story that is positive. But the real exciting part of China is the increase in consumption, and that is the real anchor of how you get to 7% growth. And quite simply, it's coming from Mao Zedong. So his one-child policy, decades and decades ago, has created a shortage of working-age labor. Because of the one-child policy, we now have an excess capacity of elderly, non-working population, but that policy has worked into the working-age demographic. The shortage in labor came about in the early 2000 period. As a result of that shortage, you've seen a massive increase in wages. So minimum wages, migrant labor costs, really across the board. So shortage in labor, driving up wages is driving consumption. The Chinese consumer is no different than any other consumer. They get paid more, they spend more. And so this increase in consumption from refrigerators to cars to bicycles to healthcare, really across the spectrum, is going to be the anchor of growth in China for the next several years.
So therefore, if I am leading the Chinese government, do I not have to be concerned about unemployment rates if there's such an incredible shortage of labor? So that's not going to be a cause of social unrest?
I think it's a lot less concerning today. Mm-hmm. In fact, one of the reasons that the focus was on 10% growth rates for a couple decades was it seemed that a 10+% growth rate was required in order to absorb the labor, the new labor. Now that there is more of a shortage of labor, a 6 to 7% growth rate is probably adequate to absorb labor. So yes, I think the labor dynamics are changing, and so it's less of a concern today if they can achieve that 6-7% growth rate.
As a global bond manager, how do you take advantage of these positive developments that you're seeing in China?
So China is so systemic, particularly to Asia, but globally. If China were to face a hard landing, countries that export to China, Korea, Malaysia, would be in a lot of trouble. So the way we take advantage of China growing at 6 to 7%, a stronger consumer, is look for countries that are exporting to the Chinese consumer. So places like Korea that sells cars and TVs, places like Malaysia that sell palm oil to China. There are going to be a lot of winners that will benefit from a stronger Chinese consumer. So we're looking for countries that are exposed to the Chinese consumer. And
when you're looking for countries that are exposed to the Chinese consumer, you are looking also at the currencies of those countries and the government bonds of those countries. Where are you finding the best value?
Correct. We're looking for places like the Korean won, which will benefit from stronger exports. Korea, for example, is now running a current account surplus in excess of 5%. It's one of the largest they've had. And that is coming from twofold. One, they're selling more to China, and two, they're selling more to the U.S. as the U.S. economy recovers. So investing in the currency of a country that is experiencing an export boom will tend to be a fairly attractive opportunity.
What about the geopolitical concerns of China really flexing its muscle and alienating and frightening many of its neighbors? I mean, Vietnam being one, South Korea being another, Taiwan being Philippines. How do you figure those into the investment equation? Certainly there are some tensions around that part of the Spratly Islands that are creating some political concern. But I think big picture, we need to look at what President Xi's administration is really about. And that's another dynamic where we get encouraged, that his administration has really anchored itself on moving China from a middle income to a high income country through productivity enhancement. And he's put in place social reforms, economic reforms to facilitate this process, one of the most important being the liberalization of interest rates. Now, that may seem like kind of a strange mechanism to enhance the productivity of a country, but one of the problems in China had been artificially suppressed interest rates, overstimulation of investment. So if they can correctly price money, you will get less investment, but higher quality investment. And that is going to be key to moving China up the value-added chain. President Xi's administration has also defined itself on an anti-corruption drive, which I think is very important for two reasons. One, his ability to effect an anti-corruption drive and arrest key members that before were untouchable is an indication of his political strength, that he has the ability to basically flex his muscle internally and fight out corruption. That gives us confidence that he has the power to effect
this liberalization process. And also, anti-corruption is a good thing. There were probably some excesses that he's trying to rein in.
So there have been instances in China in the past where there have been these anti-corruption campaigns, but you think this one has more legs?
I think President Xi has the capacity to be one of the most transformational leaders in China since Deng Xiaoping, that he actually can really affect some major change. So his anti-corruption drive, I think, is to a level multiples of what it was in the past, that he's really going after some of the big monopolies, trying to affect economic change, not just targeting certain individuals.
One of the unusual areas that you've been investing in is, and a couple of years ago, I think you started as investing in Ukrainian government debt. What attracted you to the Ukraine to begin with?
First was valuations. It was trading at fairly depressed prices. And the second was that everyone hated it, so it was completely out of favor. And through our research and going to the country, we found that there was tremendous potential in Ukraine. And from a bondholder standpoint, it was attractive in that they didn't have a lot of debt. Their debt to GDP was around 40%. So it wasn't a Greece, it wasn't an Italy where you had huge debt stocks that needed restructuring. They actually had very low levels of debt. They had one or two problems that needed to be adjusted, and most of it was the exchange rate. The exchange rate was artificially pegged or managed at too high of a value, which meant they were importing too much, they were not exporting enough, the central bank was bleeding reserves trying to maintain that. So we knew at some point that would have to be adjusted, but if we bought the dollar-denominated debt, we would be protected from that adjustment. That adjustment then came about through the crisis. So one of the structural weaknesses actually has been corrected through the crisis. In fact, I think this crisis will prove to be transformational from an economic standpoint and a political standpoint. From an economic standpoint, the transition government has really done an effective job of using the crisis to affect change and putting in place a lot of structural reforms that will benefit the country 3 to 5 years out. Those structural reforms are tough medicine, they're hard to push through, and you can only push them through in a period of crisis. When everything is going okay, politicians don't want to do the tough things. But this was a period where there was an elevated period of political tension, and the current transition government used that to affect change and to legislate a lot of structural reforms.
How do you handle a country in a state of flux like Ukraine is? But how do you protect yourself, maneuver?
So we look for what are the causes of the crisis, and are those fixable? So in this situation, we looked at why is there this massive aggression and invasion by Putin? And again, I think it had to do with Ukraine's movement to become part of NATO. And the second was a lack of state rights or federalism. And so the next president, Poroshenko, has come out and embraced the idea of the Polish federalism model, which gives the states a lot more autonomy, and that will take away a lot of the internal tension, and has moved away from the NATO inclusion. So it's going to be a difficult period, but because we see the sources of the crisis being reversed, that will give us comfort that over the medium term things will work out. We also look for international support. We look for economic fundamentals that we think will take hold over a multi-year period, not just in a short period. So we see the economic fundamentals long term. We saw massive international support from the IMF, from the US, from the World Bank. So Ukraine will receive close to $30 billion over the next couple of years from international agencies. So the liquidity is taken care of. The structural reforms will ensure long-term solvency, and we see the political environment probably getting a little bit better, even though there'll be an elevated period of tension.
Michael, one investment for a long-term diversified portfolio, we always ask our guests this, and the last time you said to avoid home bias, and if you're an American investor, look to invest in an actively managed portfolio overseas, that invests overseas. What would you recommend to us today?
Well, following on the last conversation that we had about interesting opportunities, I would say Ukrainian government debt. It's probably something most investors don't have in their portfolio, offers a very attractive yield, is certainly uncorrelated with most other parts of a portfolio. And if it's not Ukrainian government debt, it's the idea to look for contrarian ideas that are really global. Ukraine offers one of them, but there are certainly others, places like Hungary, where typically you don't have that in your portfolio, and the return characteristics are both attractive from the upside, but also from the diversification standpoint.
Michael Hasenstab, thank you so much for joining us again on Wealth Track. We appreciate your being here.
Thank you very much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is don't be afraid to be a patient investor. We have had two very different great investors on recently who are models of patient investing. As Michael Hasenstab just said in explaining why he has stayed out of Treasury bonds for years, he would rather be early than wrong. FBA Crescent Fund Stephen Romick recently told us he is holding the second largest cash position ever in his portfolio right now because he can't find investments at the right price. As hard as it is, sometimes it pays to do nothing and wait for that perfect pitch. Well, next week we will have an exclusive TV interview with financial thought leader and energy guru Tom Petrie. He'll share his 40 years of perspective on the so-called energy revolution and what it means for investors, the economy, and national security. Also, in the Wealth Track Women's section of our website, our award-winning financial advisors will focus on the role prenups should have in a women's financial plan. Single, divorced, about to get married, you will want to hear what they have to say. Have a wonderful Father's Day weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation.